Hello, everyone, and welcome to the MakerDAO Scientific Governance and Risk Meeting number 116, taking place on Thursday, October 29th, 1600 UTC. My name is Long for Wisdom. I'm the governance facilitator at MakerDAO at the current time. I'm joined with a whole bunch of people interested in Maker. And yeah, we've got a bit of an agenda today. We're going to start off talking about the recent issues with flash loans. I think that's probably on the top of everyone's mind. So we'll kind of talk about that a little bit and get some discussion going first, and then we'll kind of carry on with our usual agenda, which includes the usual weekly updates, the governance cycle review quickly. Then we're going to have segments from Hugh Karp from Nexus Mutual, who's going to talk about insurance for the MakerDAO, the Maker protocol. And then hopefully, if we get time, the regular session segment from Bishesh, talking about the state of the peg. All right, so I guess preamble stuff. Yeah, if you're in the meeting, feel free to interrupt and kind of comment when people are talking. We'd love for you to join in. If it becomes a problem, someone will let you know. So please don't be shy. Going to do my usual reminder about time zones and daylight savings. This meeting is in UTC. Daylight savings has happened for me, but I think it may be perhaps on Sunday for a couple of other zones. So be aware after that changes. This meeting might shift slightly. All right. I think that pretty much covers introduction stuff. All right, so I guess I'll just do a brief kind of introduction recap of what happened with regards to flash loans. Then kind of Chris can talk a bit, and then we'll kind of open up the discussion a little. So I posted a forum post the other day talking about how on the October 23rd executive, I believe it was, a flash loan was used to pass the executive. This was a normal planned executive, it wasn't malicious, but it did kind of highlight that flash loans can be used to influence governance. That kind of led to a kind of reevaluation of the flash loan risk generally, and the potential for actually malicious executives to be posted and passed using flash loans, and was deemed to be kind of a risk that we should probably deal with. So I'll post the forum post here so people can read if they want to, if they haven't already. But yeah, so there's kind of a summary there. We kind of talked about some actions. The main one being to encourage more Maker to get on the HAT proposal, which helps prevent malicious changes, and also preparing an executive spell to increase the GSM governance security module pause delay from 12 hours to 72 hours, and to deauthorize some of the modules that were able to skip that pause delay. Chris, do you maybe want to talk a little bit more about, I guess, the changes and how, I guess, and how you sort of found the issue and kind of what's been going on?
Yeah, I think that's probably a good idea. So I actually kind of wanted to bring up that there were, in a way, there were kind of two incidents. The first is that, yeah, sure enough, last Friday's executive finally went live on Monday via a flash loan, which is probably not great considering most of the mechanism design behind MKR is that MKR holders have skin in the game. And so, that's alarming enough to prompt a reevaluation of the sort of flash loan risk. But then shortly on the heels of that, a second incident, nothing really happened, but on the 27th, the amount of MKR for the first time ever that was available in the open markets for flash loans exceeded the amount that was on the HAT. And so in our mind, that's the sort of big urgency about flash loans right now, is that for a brief window of time, if you were paying attention, you could have flash loaned and pushed in a malicious governance proposal from 0 to scheduled, which would have put a lot of sort of urgent burden and work on us to try and drop that proposal. A lot of organizing MKR and trying to clean up that mess. So those are the sort of two incidents. So right now we think that that risk is probably going to persist. I know it's mitigated right now because we have enough MKR in the hat, with quite a bit on the hat, over 120,000 MKR last time I checked. I don't know if somebody could drop that number in the sidebar. But what we did is we sort of weighed the risks of having, first of all, we had a few instant modules outside the governance delay. So the modules outside the governance delay, one of them is to freeze the Oracle feeds. And so we originally put that in place because, there's a feed list, and over the course of time, we've been adding a lot more feeds to that list. The more feeds we have on the list, the less likely we are to suffer Oracle attack. So there's still a risk there. We want the ability to sort of freeze those feeds, but the risk that somebody maliciously freezes a feed with a flash loan is greater at this point than the risk that we have, feed corruption and somebody like manipulates the price. So we're thinking we need to put the Oracle freeze. We're actually just going to remove its privilege so that if you want to freeze the oracles, you have to go through the GSM delay. And then the same thing with liquidations. So the liquidation circuit breaker we added shortly after March 12th was to sort of circuit break the liquidations if they weren't performing correctly. And since then, we've also upgraded to liquidations 1.2, which has the box and sort of limits our sort of upside exposure for how much, I guess, exposure the bad or ill-performing liquidations could sort of wreak on the protocol. So, the problem is that instant module is there. So an opportunist could try and disable the circuit breaker, or they could attempt to, even maybe worse right now, they could disable a circuit breaker. And we have circuit breakers on USDCA, which is probably the most alarming. So someone could instantly sort of turn that circuit breaker off, and then all of that USDCA that's up for liquidation would be liquidated on the market right away. So the risk of that, because of flash loans, also became greater than we believe the benefit, the risk of what the circuit breaker was trying to solve, mostly because of the addition of the box in liquidations 1.2. So again, we're going to remove the privileges from that. We're going to put it behind the GSM delay. And then with regards to the GSM delay, 12 hours if a malicious governance action gets scheduled, which one very well could, is a short time to sort of muster enough MKR holders and take action. I think we could do it, but we thought it would be a lot safer to, I guess maybe mustering the MKR holders is probably the harder bit. So we were suggesting 72 hours for the governance delay. That would give us, imagine if something bad happened on a Friday, that gives us an entire weekend plus a day in order to sort of align enough MKR holders to act. And so those are the three recommendations. Again, they're extend the GSM delay from 12 hours to 72 hours. They are to remove privileges from the OSM freeze module and to remove privileges from the flipper or the liquidation circuit breaker. So yeah, I'm happy to take any questions, or if anyone wants to have some discussion, that'd be great.
Yeah, I just want to chime in on what the trade-offs here are. So you mentioned that one of the trade-offs, at least, right, is that the Oracle freeze module is now subject to the governance delay, right, which we're now proposing to be 3 days or something. So that affected. So right now, if there is an Oracle attack, right, and an Oracle attack can happen in a number of ways, but the two main possibilities that I see is either that someone manages to compromise a bunch of the feeds, right, in order to reach quorum and submit a malicious oracle price. The other manner is that someone looks at what price sources we're using for an asset, and then tries to manipulate those markets temporarily to get the feeds to legitimately post this distorted market price. Now in the past, we would have had this, right, it goes through an OSM delay, right? So the Oracle security module delay is 1 hour. And so in the past, we would have had this 1 hour time window to basically fix this, right? And by fixing it, usually what we mean is that we would activate this kind of Oracle freeze. So the trade-off here being that if any kind of Oracle freeze now is subject to the governance delay of 3 days, then if there's an Oracle attack, I mean, we're suffering through that attack. We don't have a mechanism to actually freeze the oracles in time before the malicious price takes effect. So it's not that we get this flash loan, governance protection for free. There are trade-offs. That being said, I do agree that the risk of a general governance attack through flash loans, right, given the amount of liquidity in the market, is much greater than the risk of an Oracle attack. I just want the community to know, exactly what they're giving up here.
Yeah, and I'd like to jump in there really quickly to make the point that the next priority, after this immediate sort of emergency action executive, would be finding a way to safely re-enable the ability to instantly freeze oracles or trigger a liquidation circuit breaker. And we're still kind of kicking around the best way to do that, but that process is kind of drawing rapidly to a close. And within the next couple of days, there should be a concrete recommendation put out by the smart contracts team to suggest the best way to do that. And then the community can go forward based on that.
I mean, one thing I would like the community to consider is perhaps if they want to give the Oracle domain team an instant access module to be able to freeze them. But that, to be fair, that's a big step in the centralization of power. So I would totally understand if there's some reluctance to do that, but that would definitely be one option.
I'll add that all the things we're working on are, fully decentralized MKR controlled mechanisms, but that could be an even shorter term intermediate step that just give authority to the Oracle's domain team.
All right, thanks for adding that color, Nick and Kurt. Yeah, anyone else have any comments or questions or anything?
Can you hear me now?
You're a little quiet, Brian, but yeah.
You're really quiet.
Oh. Hey, Nick, do you need the ability, if you were to have your own flash loan or your own instant action module, would you need to be able to flip the OSMs individually, or would it be sufficient to flip them all at once?
It would be great to have the granularity to toggle them individually, because like I said earlier, right, there's two styles of attack, right? And if you can manipulate, all of the feeds directly or blackmail all of the feeds, right, you may as well change all of the prices, right? Because you have the quorum to do that. But in the alternative attack where you're manipulating the price sources, in that case, right, the attacker is really only able to manipulate one oracle. So it would be quite disruptive if we only have to fix one of them to then shut down all of them, right? I mean, it's right, the difference between like, hey, you can't use KNC for the next day or two versus you can't use the maker system at all, right?
That sounds good. We can iterate on this offline.
Great. Yeah, thanks for that, Brian. Yeah, like I was saying, if anyone else has any comments or thoughts, please do chime in. I'd love to hear from more of the community.
I would like to say from a non-technical perspective, like if you as the community want to help, your maker that is on liquidity pools can be used to attack the system, and you would be encouraged to add it to the hat to protect the system. This is something that we've known since December when Mika Ziltu posted the Medium post about this exact thing, and since then the liquidity available has just been increasing. So I mean, we are now strongly incentivized to increase technical solutions for this, but there's still the option for the community to do their part to protect the hat.
Yeah, maybe I'll just sort of echo also from a non-technical perspective. So let's assume in the next week or two we've got a nice fix for flash loans. That still doesn't remove the risk that one of the sort of lending platforms that just lets you take out an MKR loan for some period of time, that's not going to be an economically viable attack as well, which really does mean if you're an MKR holder, you should be careful about where you're providing MKR liquidity. And I think I'll leave it at that and maybe just leave that discussion for everyone else. But so yeah, even once we solve all these problems, there's always still going to be a little bit of a risk. I mean, the delay helps us, but it's once we have those instant access modules back in place, it's still, if you're an MKR holder, you need to be thinking about these things.
So I posted about this in the chat, but I was thinking about like maybe a solution where we could split the value from Maker with the voting capability of it, and potentially make some sort of new token that holds the value of Maker through technical means, and it does not allow for voting. So I had an idea for this, that maybe we could have a new token called non-voting Maker, where you can mint it by locking up your Maker, but to unmint it, you can only do it if you've previously locked up Maker, so it's not fully fungible. So I posted a little sample code for this, but it's just some food for thought. I'm still kind of going over the economics in my head, but I was thinking maybe something like this could be a solution.
Now, Sam, we already do have IOU tokens. So when you deposit your Maker into the voting contract, you get tokens that are transferable. I mean, there's probably no reason why you couldn't create a Uniswap liquidity pool to do that. We don't encourage that, obviously, because it does separate the value of the Maker token from your voting rights. But I think we might already have the solution.
Okay, well, if that exists, then maybe encouraging whales to use that so they can use their Maker as collateral without giving up their voting rights.
The only thing is the IOU tokens are essentially deposit slips for the Maker, so you'd have to.
I think it's quite the same mechanism. But yeah, that's probably something to pursue, like kind of offline or on the forum, Sam, if you have further ideas there. Cool. All right. Yeah, I mean, does anyone else from the community have comments or thoughts on this? Because I'm kind of aware that we've kind of reacted to this fairly strongly and like without sort of doing the usual signaling or polling process. Hopefully the reasons for that are fairly obvious and hopefully people think they're valid. But yeah, like please feel free to comment if you have any thoughts.
I mean, you're basically talking about splitting up the equity, basically treating it like preferred equity and common equity, where preferred equity could vote and common equity wouldn't be able to vote. But ultimately, the MKR that wouldn't be able to vote would trade at a super discount, because at the end of the day, the real value in MKR truly ends up being the fact it can vote. So the real question, in my mind's eye at least, just turns out to be how we put together a system that defends from the flash loans today, that's fine, and then puts together an economic solution where it has a cost, We can always talk later about how to put together incentives to let people keep MKR on the hat or in the executive contract. But in general, that there needs to be a cost associated with borrowing the MKR to put into that executive. Clearly, it's once it's past 1 or 2 blocks, one thing. But if you had, let's just say, a 1-month delay before your voting rights would be usable, I mean, there's an economic cost not only to borrow it, but to keep borrowing it for a sustained amount of time. You basically dissipate all of the terms. But if you bifurcate those two and get rid of the voting rights, I just think the MKR that wouldn't have any voting rights would trade for nothing.
Well, I don't think that's the case. I mean, it's useful as like collateral to take out a loan or something like that. You can, like, the price is valuable.
But that's my point, though. If it's that's what we're talking about, though. If it's only valuable if it's tradable, and its value is driven around its voting rights, is from my perspective.
I think we may be getting a little bit off topic here in terms of the specific solutions. To your point, Matt, I think we will be looking at kind of the economics around like voting and things more with the DSS Gov update. I spoke to Chris a little bit about it the other day. I think we're hopefully going to talk about it more in the future to figure out how we can kind of incentivize people to keep Maker locked up in that in the governance contract, and hopefully or make voting with borrowed Maker more problematic or costly. Yeah, so Chris just made another point in the chat, which I'm going to echo because it is important. The Maker holders providing liquidity on like AMMs, like while it is a risk there from this flash loan thing, like that is also valuable in other ways, right? Because we need MKR liquidity to do flap and flop auctions, and just generally so that Maker is tradable. So there are trade-offs to doing that. And if you are doing that with Maker, I would suggest just being or trying to stay aware of how much Maker is on the hat and in the governance contract versus how much is being provided for liquidity. All right, any other comments before we move on? No, can't hear you, Lev.
Can you hear me now?
Yes.
Oh, perfect. I just wanted to say that for the purposes of this problem, there's kind of 3 different ways that people are providing liquidity that might be problematic. The first is like lending platforms like Aave and Compound. I mean, Compound doesn't have MKR currently, but same idea. Some of those lending platforms might support flash loans. For example, like Aave. The second kind is AMMs that have their liquidity accessible with a flash loan. So Uniswap v2 is an example of such an AMM. And also the ones that don't natively support AMMs, like Uniswap v1 and Balancer, can still be used in combination with another flash loan by basically trading the borrowed asset back and forth during one transaction. But there's also AMMs which don't make your assets essentially flash loanable, like for example Uniswap. So it's actually not inherently the case that if you're providing liquidity in some sense to MKR that you're actually making it available for flash loans. So it's worth keeping in mind that there's more nuance there.
Great. Yeah, thanks for making that point, Lev. Cool. All right, I think we'll try to move on. If anyone has more thoughts about this, the forum thread I linked and the other ones in the forum about this are a good place to kind of make your arguments, leave your concerns or points. I would encourage everyone to kind of do so. I mentioned, Chris mentioned, sorry, earlier that like there were kind of 2 things that happened here, and I would kind of like to echo that in that the first one, which is the more pressing issue, is the risk of kind of a malicious attack. But there's also the second issue where people can pass proposed like executives that benefit them using flash loans, even if they don't own MKR, which is less of an issue, but it's still an issue, and it's something we're gonna have to figure out how to deal with as well, which I haven't really even started thinking about. So we're kind of dealing with a more immediate pressing issue, but there is still another issue we have to deal with, which will hopefully be addressed in the coming weeks. So for now, though, let's move on to updates from the major teams. All right, I think I'm going to skip governance at a glance for this week, just for time reasons. It is updated on the forum if anyone's interested. Otherwise, governance updates has just been kind of me dealing with this mostly, and continuing to try and recruit people to help with governance-related things. Chris, if you have anything extra to say about smart contracts, feel free. Otherwise, we can move on.
Yeah, I'll see if I can go through pretty quick. Most of it is obviously we got randomized onto this, so things changed a little bit. So the weekly executive for the surplus buffer going from 2 million to 4 million passed, and also the sort of B protocol approval for the OSM and medianizers passed. I do kind of want to lighten the mood a little bit here and say that I think it's fair to say that the curse is still in effect. So for those that don't know, for a while, whenever Kurt would make an executive spell, it would never pass. This time, when he deployed the spell, the transaction hash had 0xDEAD at the front, which was a little alarming. And then, yeah, obviously it was flash loaned to pass and has now randomized us. So maybe we'll keep Kurt off of executive spells for a while. We love you, bud. So the monthly executive bundle passed, and we did no collateral assessments. We pushed Wi-Fi-A to Kovan, and Sam's been working on GUSD-A this week to Kovan. There's still a little bit of tooling work that happened on the DSS exec-lib. There are no changes to the collateral onboarding priority sheet. The documentation for collateral onboarding is in final review and will probably be posted reasonably soon. There's no domain team reviews from last week. So this coming week, obviously we've got this executive that we talked about. So the three things I already covered. Then we're gonna put off probably Wi-Fi and balancer until maybe next Friday, but it's hard to say if we end up pushing some other more urgent change to try and fix the flash loan thing. That'll take priority. So if there's nothing there, then Wi-Fi and Bal can go out, probably because they're pretty much ready to go. So assessment work, I think we're going to do some of the Uniswap V2 tokens because we're targeting the end of November for Uniswap V2, for USDC FA and DAI FA. Those are the two that are at the top of the priority sheet. Still on that list is just Uni, Ren BTC, and TBTC. And domain team reviews. Again, this is more backlogged for MIP 14, 17, and 25. And then just that the foundation's continuing to engage auditors for liquidations 2.0. And now that team has been sort of randomized onto working on, but basically, probably hoisting some features back from what we were going to do for DSS Gov, but that's not set in stone yet, so we don't know. But they're working on the mitigation for the events this week. Also, I'm gonna post a link. I don't know who's in this channel or if maybe Charles is going to mention it, but there's a collateral onboarding updates external channel. And I don't know if people can just join that. It's in the sidebar, but it's intended for just announcements. It's a read-only channel aside from domain team actors. And anyone in the ecosystem is encouraged to sit there if they're waiting on alerts for, maybe testing a new collateral type in Kovan or testing, or when something gets pushed to production, testing any aspect of this stuff. So that's the sort of pipeline. That's where like pipeline announcements will go. This is, anywhere from people using UIs to other domain teams and all the way down to like even just people running keepers so that they know they need to sort of update their keepers to manage these new collateral types. And that's it.
Great, thanks, Chris. Oracles, Nick, any quick updates?
I mean, besides that someone, wanted to use our Oracle so bad that they flash loan attacked us. I don't know how to feel about that. There was besides that whole thing, there weren't any polls or any other executive stuff that happened in Oracle land. As far as what we're working on, this week we deployed the balancer and waifu oracles, so those are ready to go. But like Mooney said, basically, we may push off the onboarding for those in favor of doing executives for the flash loan gov attack fixes. In terms of what else we're looking at right now, I've basically completed all the stuff on the tech side for PAX-G and for the Aave token, as well as for GUSD. So those should be ready to go shortly. And right now I'm basically exclusively just focusing on the LP token oracles, because it's a big change from our regular Oracle stack. It's basically just a standalone smart contract. So we're basically trying to just get as many eyes as possible on it. The other thing is that this is a contract that we're going to want to get audited. But because of how busy most auditors are, if we did do that, then it would take like forever and a day, to finally onboard the LP tokens. So I think the healthy trade-off here is that we can onboard the LP tokens kind of targeting end of November, but we'll just have to really restrict the debt ceiling. So if there is some kind of bug that, the damage is kind of contained. And then in parallel, we can be seeking audits. And then as the audit results come back, right, we may need to make some changes and redeploy the Oracle, or we may hear back that everything's okay. And as we kind of go through those, then we can feel more comfortable raising the debt ceiling to more reasonable levels. Yeah. But the good news is that once we have a contract in place for one of them, we can easily deploy it for all of them. So you only get that really big kind of friction once, and then you get all the other ones for free. And yeah, that's it. That's it from my end.
Great. Yeah, thanks, Nick. Looking forward to seeing those come in. All right, Primož, risk updates.
Yeah, so there's ongoing work on collateral evaluation, currently finalizing Crane BTC, but as Nick said, starting to focus more on UniLP tokens, as was kind of agreed between domain teams. UniLP is a bit non-standard to evaluate from our side, but we think if really something like ETH DAI or ETH USDC, we would actually de-risk the portfolio due to lower volatility of such asset. Plus, I think higher debt ceiling could be applied from our side because, for instance, if really something like ETH DAI is collateral, the unwinding of such vaults should carry less slippage because collateral itself holds DAI. The only missing part is whether we can soon implement a feature that will have farming supported by vaults, which would definitely attract more demand than otherwise. As for rate changes this week, the rates working group proposed one change, which is to lower ETH-B stability fee from 6% to 4%. We believe 6% is currently too high, especially since farming yields dropped and cost of capital now kind of plays more important role when people decide to leverage. So I still think it was a good experiment to see, what's the borrow rate threshold on lower liquidation ratio ETH vault types. And by lowering it now to 4%, if it gets passed, we might get a more clear signal from maker users about rate sensitivity. So there's already a signal on stablecoins fees, which I think just ended today. It seems stability fees on stablecoins will remain unchanged at 4%, and they will remain at 4% until leading stablecoin vaults reach 100% collateralization ratio. And I think this should be in mid-December. This means we might also need to have another discussion about potentially raising surplus buffer. But I also think that might not be necessary, because the 4 million surplus limit that is effective now will be reached, I think, only a few weeks before we disable fees on stablecoins. So I personally think the best thing to do is just wait until we're close to the limit and then evaluate the whole situation. And then the last thing I want to point out is that Maker now has a lot of unutilized app ceiling for certain vault types. We know it's hard to manage it efficiently without having instant access modules that I think MIP 27 aims to implement. Yeah, MIP 27. But still, we might want to decrease certain debt ceilings, such as those for ETA, where there's more than 200 million unutilized. There is also a bit of a problem with mana, where liquidity metrics got much worse in the last few weeks. We might need to decrease debt ceiling even below the current debt exposure, which is currently at about 400,000 DAI. The new models that we use now, and they're testing them for risk parameters, they're suggesting a debt ceiling of around only 203,000, between 200 or 300,000 DAI. And that's because liquidity really got worse and much of the volume happens just on Huobi. And we know there's usually some wash trading there. So I was actually thinking this week, actually next week, we might want to do a larger executive vote on debt ceilings, where we first propose debt ceiling increase for Red Bitcoin and Link, which was already signaled, but then at the same time propose a decrease for ETA, potentially also ETB, same time decrease for Mana, and also for USDT, because there's a signal which is still pending, but it seems majority voted for a decrease to 2.5 million. So I'll make a post soon about these debt ceiling proposed changes, which if they're agreed on between community, they could go into this Monday's on-chain poll. And that's it from our side.
Great, thank you very much. Yeah, I think any questions or anything or comments on that proposal can probably go in the forum. And pretty much post it.
Just one quick question just on the
Sure.
prioritization of items. Where you outlined just in general that there's a Uniswap LP priority, and at the same time there's been a poll about the prioritization of real world assets. Just curious which ones are getting priority.
On our side, there's not really a major difference because the real world assets are now covered kind of by a separate team. I'm involved as well, but Sebastian and Will and Phil are working on them. UNLPs on our side are covered by so-called regular evaluators. So we don't really, we shouldn't really have a problem with that. This is for the risk domain.
Yeah, for smart contracts, I think we, in all cases, just need to do the normal token assessment of what's going to go in for the real world asset. Matt, I think I had reached out and sort of mentioned something about that earlier, but then we're just going to start trying to push it through the onboarding process, and we'll build the sort of deployment spells and whatnot that we need to push real world assets. And while we're doing that, I'm sure we'll find like certain complications or other things that we need to work on. But I think it's going to be an ongoing process. So I would say that's the that's like our baseline. Like we'll be working on real world assets while we're also doing these sort of like easier ERC20s. So
thank you.
All right, let's move on then. So next, I believe it's community development and operational support. Amy?
Yeah,
I'll brief update for us.
I'll be pretty short here to save everyone some time. I did submit the operational support domain for formal submission. So both the domain itself, a MIP for the domain, and then the sub proposal proposing myself as a governance, or sorry, as a operational support facilitator. And then I'm also working on submitting a budget MIP soon, as well as I do hope in 2 weeks we will be launching our grants platform, which would allow applications to be a little bit more visible to everyone. And it'll give, in my presentation, I'll give a little bit more about what the process is and a lot of the data that we've collected on how we award and distribute those grants. So that's just it for me.
Okay, yeah, thanks for keeping it quick. Juan, you wanted access here. Cool. Have you got a collateral call or collateral update for us?
Yeah, just a quick update from my side. Can you see the screen? Not yet, no?
You can now, yes.
Okay, great. So as a quick collateral onboarding update, yesterday we had two calls. The first one was with Console Fright. So Alejandro and Ernesto were there from Console Fright. There was also people from the Centrifuge team. Ventures was there. It was quite interesting. Then after that, we had the Curb Finance team. We had Michael, Angel, Charlie, and Julian joining us. Also very interesting call. Actually, Julian tweeted to get the CRV token passed, as he saw that participation was relatively low at around 3%. I don't know if that helped on the poll or not. And then yeah, we discussed which other liquidity tokens could be brought to the Maker ecosystem. Just a quick reminder, if you're good at any of these topics, so risk or data analytics, speak with Primoz, oracles, or anything backend related with Nick. Chris Mooney for smart contracts, any full stack developer or comms with Tim and Amy, governance for Long for Wisdom, and notes and scribes with David. Yeah, and I think the application for the Kleros Maker Foundation Fellowship, I believe is still open. Amy, please correct me if I'm wrong. So there's still time to apply. There's a forum link down there with more information. Okay, Amy confirms that they are still open. And finally, we created a small MakerDAO contributor pop. Okay, I didn't put in the slide that it was for Q3, and we are also going to be doing another one for Q4. So it's a shiny NFT for your Ethereum wallet with the people from the Pope protocol, as Amy announced, I think last week. So yeah, fill that Google form either on the link or the QR code, and we'll make sure that it's in your wallet soon. And that's it from my side. I don't know if there are any questions. Okay.
Thanks for that, Juan. Cool. All right. Charles, do you want to do a MIPS update? There you go.
Thank you. Hello, everyone. All right, so this week was the last week of October's governance cycle. So we had the monthly executive vote published on Monday, and I'm happy to say that the executive passed on October 27th and was executed yesterday on October 28th. So today, Long for Wisdom is going to perform the governance cycle review, just summarizing this month's activity and opening up the floor for any feedback and discussion as always. And if we do have time, we may be able to talk about some of the proposals that are aimed for November's governance cycle. The proposals that were officially accepted by the executive vote are all displayed on the screen here, and they have all been moved to the accepted status in the MIPS repo and on the MakerDAO forums. So if anyone wants to go and check these out to see what exactly is now effective law for these certain areas, then go check out these proposals if you haven't already. Next week marks the beginning of November's governance cycle. We have the formal submission period ending on Wednesday, November 5th. And I've been coordinating with the authors of the proposals who've completed the RFC period, some of which have already submitted, formally submitted their proposals for November, as Amy mentioned earlier. And then next Thursday, we'll have the submission review to determine which of the formally submitted proposals can be put forth in the inclusion pools for November's governance cycle on November 9th. The proposals that are still in the RFC phase are displayed on the screen, and we have a few of them already formally submitted. So the Flash Mint module has been formally submitted, as well as both the operational support domain definition and the subproposal to onboard Amy as the operational support domain facilitator. All the others, I believe the calendar exceptions will also be submitted, and the source cred funding. And I still have yet to get in contact with Planet X about his intention to potentially submit the MIP 17 weekly actual debt ceiling adjustments, and Derek for the governance contract redesign and the debt ceiling incident access module. And lastly, we have the emergency response. So the new author is now David Utro, taking over from John. And he does also plan to submit that to November's governance cycle. And I believe the final changes have also been incorporated if you want to check that out.
And quick note about that one, it actually replaces MIP 5.
Yes, yes. So that is the emergency proposal defining the way to put up last minute votes, as well as emergency offboarding of a governance facilitator if they were to act maliciously or have other intentions. And if David, you do want to talk a bit more about the details of that, feel free to do that when I conclude this segment. Please and thank you. So yeah, in terms of cloud onboarding updates, the domain teams covered a lot of them so far, but we have Wi-Fi and Balancer executive vote to be published this Friday to officially onboard them to the Maker protocol. So don't forget to vote when that goes up. The collateral prioritization framework has been made public. If someone could share that link in the chat. I know Juan also mentioned it, and it was published last week, so maybe people have already seen it. But that will be a great tool for the domain teams to help assess and prioritize all the collateral applications that have come through the cloud onboarding process and help inform their decisions on what to work on next. In terms of the immediate next collaterals, PAX G and GUSD governance polls were published on Monday, and they have both passed. So the executive vote to officially add them to the Maker protocol will be scheduled within 30 days. I believe a couple of the domain teams mentioned it may be next week. And lastly, the community greenlight polls for October's cycle are still live until November 2nd. So this is a reminder to vote. If you see a collateral type that you think should be added to the protocol, go and vote yes for it. If not, vote no. But they will be up for a couple more days if you want to make an impact on the polls. And lastly, as usual, we have still some ongoing conversations in the pre-proposal discussion section of the forums. The main ones with the most conversation are the MakerDAO liquidity pools, the MakerDAO protocol coverage using Nexus Mutual, and lastly, the Flapper distributor, a way to distribute the system surplus while minimizing governance friction. So that is the update for today, short and sweet. If any of the authors want to speak to their proposals aimed for November, please go ahead.
I think we'll have to skip that this week. We're a little short on time.
No
But yeah, if any of the proposers do want to talk about their MIPs on this call, feel free to get in touch with me, and we can schedule you in. All right, so I'm going to do a really brief governance cycle review. So as Charles said, we passed, I think, 5 MIPs, 3 sub-proposals. These are all fairly hefty MIPs with kind of a lot of implications. We had protocol DAI transfer, which is the first time we've set up a process to transfer DAI out of the protocol to someone for some service. We approved MIP20, which once smart contract work has been done, would allow us to enable negative rates on DAI. Not that we necessarily would, but we would now have that option. There's the real-world assets MIPs, and there's some structural stuff as well. So yeah, a lot of kind of heavy stuff. If anyone has thoughts about how the cycle's gone, I think the forum is probably better at this stage, as it's a little short on time. So I know Charles does a MIPS update post. If anyone has kind of pressing thoughts or comments they want to make, I would suggest putting them on that post. Kurt's mentioning a negative rate-like mechanism. Yes, it's not exactly negative rates, but yes. Cool. All right. I think we're going to move on to Hugh's section then. Hugh, are you prepared?
Yep.
Make you co-host so you can present.
Cool.
Don't mash any of the buttons.
Hold on, let's see if I can get this to work. Okay, cool. Hope you can see that. So yeah, thanks everyone. I'm good to be here. I'm Hugh Karp. I'm the founder of Nexus Mutual, and I suggested a potential coverage for MakerDAO as a protocol. So it's basically building a tailored policy for MakerDAO on Nexus, and the main objective is to address the potential for the pro-cyclical issue that MKR has when it covers bad debt. So basically you have this issue where MKR is burned at high prices when you're accruing fees, and then if there's an event, usually the MKR price may drop, and then you mint more MKR at that low price to pay off the bad debt. And so we're aware that Nexus could in the future cover a larger section or a larger chunk of potential bad debts that might accrue to the protocol, but Maker is bigger than Nexus at the moment, and so there are limits that Nexus has, and so the main use right at this moment would be for dampening of the of MKR's pro-cyclical nature, and so the idea being that if you look over a cycle of paying costs in terms of the cover versus the claims that you get back, assuming that that's negative EV over the life cycle, there's still a big positive benefit from the actual value of MKR that's net burned or minted, but I can go through that. So the proposal in summary, and all of this stuff can be tweaked, it's just something to put out there, is that you could buy tranches of cover on Nexus for, say, 3 million DAI worth, and then if bad debt was to exceed 5 million DAI, then one tranche of claim is paid. So, and at 10 million, then you pay two tranches, so 6 million in total. And so kind of up to 60% of the bad debt is covered. I think it's quite important that not all of the bad debt is covered, because we still want alignment of interest between risk management of Maker, and so I think that's important, but this is really a potential dampening mechanism. In terms of kind of limits and pricing and stuff like that, the total maximum cover right now on Nexus would be about 12 million DAI, and it'll grow as Nexus grows. So you could, for example, purchase 3 million tranches. The minimum pricing actually got dropped last week to 2.6% per annum. The actual price is determined by staking, the number of people that want to back it. So it is kind of unknown at this point, but that kind of gives you a range of what the pricing might be if this was to proceed. And I guess in general, if there's a known decent amount of demand, I would expect a substantial amount of staking on Nexus. That's what we've seen in the past. Yeah, there's obviously a bit of a range here, and it depends on the staking, but it kind of gives you a flavor for where it might end up. To give you kind of an example of what could happen, using Black Thursday as an example, and apologies if I didn't quite get the numbers right. I've tried to get the right ones. I believe there's about 5.3 million of bad debt accrued, and that resulted in nearly 21,000 MKR being minted. If you had the protocol cover, then you would have avoided minting something like close to 12,000 MKR. And then if you make some assumptions about negative EV in terms of the cost of the cover, but essentially you pay that at the MKR price pre the event, so kind of the higher price rather than the lower price, then you still save in terms of MKR minting over the whole cycle. So that's the I wanted to keep it short. That's the main proposal. In terms of other kind of key questions that people have asked, claims assessment, how claims assessment's done, because that's kind of probably an important one. The Nexus mutual members vote on claims, and I guess one of the key things there is why would they approve to pay a claim, and that's kind of the key to the fundamental thing we're doing at Nexus. And so all of the incentive mechanisms are designed to ensure that legitimate claims are paid. I won't go into the massive detail about all of that right now, but you can definitely look it up. And there's kind of two layers to the incentive structure to pay genuine claims. So I think that's kind of I really just wanted to whiz through, give you the overview, but it's probably more of a corporate finance type decision here rather than kind of ensuring tail risk or something like that, because it's a bit different right now given Nexus's size versus Maker's size. But I still think there's potentially a lot of value here in it, because the pro-cyclical nature of MKR has, I guess, been discussed quite a few times in the past. So yeah, I might just stop there, and if anyone has any questions, I'm more than happy to answer them.
Yeah, great, Hugh. Thanks for the presentation. I think that was kind of clearly explained the proposal, which was awesome. Yeah, I mean, like you said, I'm open to them for questions. I kind of was like, when I originally read this, I was kind of didn't understand the benefits before I kind of understood the effect it has on the kind of cyclic nature of Maker minting and burning. So I thought that was, so once I kind of realized how it would help, I thought that was good, or kind of useful to understand. I know a couple of people in the forum were quite positive and others were quite negative. If any are here and want to comment, I would appreciate it.
So Hugh, I guess the downside is that Nexus Mutual doesn't survive the next 5-10 years or even less, or is it that Nexus Mutual governance doesn't approve the payout? And what would be the difference between just going out to Barclays and getting insurance from them as opposed to Nexus Mutual, in your opinion?
I think the first one is you'd struggle to get any cover just because it's so tailored, and they don't understand the details right now. That may be available in the future. The second one is that the payment could be made on chain directly into the right contract. I'm not quite sure what that is, but then that would directly avoid the minting of MKR. So there's like a direct level of integration there that can provide a big benefit in terms of avoiding actual auctions taking place. So yeah, honestly, I think you'd spend 6 months going around Lloyd's and various other insurance brokers and not really getting anywhere, because this isn't a standard product at all.
Got it. So I guess you're saying that for someone like Lloyd's to cover one of these protocols, it's just way out there, maybe in the future, but not now.
Yeah, exactly. And they give you cover in US dollars, and then you'd somehow have, obviously you'd have to get the claim payment into the protocol and stuff like that. So there's quite a lot of details behind it, even if they were to come up with something like this. So yeah, I think they're quite risk averse. I think one just to give you some flavor, just very, very quickly. Some of the cold storage that's been placed with some of the big providers, I know has been shopped around. Like someone wanted 100 million line, so 100 million potential claim payment, and it was split up between 10 different people, which is just basically unheard of. And it just means that the regular insurance industry is very risk averse on this stuff for right now. They don't understand it. And that's just for like cold storage stuff, which is very close to usual crime type policies. So it's not really moving very far out of their kind of current comfort zone. Anyway, long story short, I don't think it would be worthwhile. I'd recommend not doing anything rather than going out for that type of stuff.
You mentioned something that kind of gave me a thought. You mentioned the payment can be made directly into the protocol. So normally the way the protocol works in the event of bad debt is that flop auctions are triggered a fixed amount of time after the bad debt happens. I think, not entirely sure what it's currently set to, it might be a week. So my question maybe would be like, how quickly would Nexus Mutual governance kind of approve or deny a payment, right? Like, in order to prevent the maker issuance thing, it would need to happen before that timeout expired, 6.2 days.
Yeah, exactly. So 36 hours minimum payment should be finalized within 72, though it could go a bit longer than that. So like it's not absolutely guaranteed to get under your kind of week, but in nearly all circumstances it would.
Okay, thanks. I mean, that is a value we can tweak. I think we could probably push it back if Nexus were actively considering it, I think. But yeah.
Yeah.
I have one question regarding the pricings. So are those prices, fixed and static, or let's say we increase the, loan portfolio of maker, would the pricing change then, or is it just fixed for a determined time?
The pricing's fixed for a whatever cover period you purchase, and then so say you bought cover for a year, that would be a fixed price, and then say that expired and you wanted to renew it, and over time you have different risk parameters, I guess, onboarded different collateral and stuff, then Nexus Mutual stakers may have a different opinion, and the renewal rate may be higher or lower depending on the staking at that point. But it's a fixed rate; it doesn't vary on an ongoing basis.
Okay, thanks. How do you manage that capital is locked inside Nexus? I've read something about it, but could you just explain?
Yeah, we have this concept called the MCR, which is our minimum capital requirement, which is what we require to hold to kind of back the covers that we've written, and no one can take the money out of Nexus unless we have funds above our MCR, and so that basically that means it's not an absolute guarantee, because insurance companies are aiming to be under collateralized and diversify risk. So we don't always have more money than we have potential liabilities, but the whole point is that we have a certain amount of money that has a very high likelihood of paying all legitimate claims. That's the goal. So it basically uses the same structures and regulation and theory and actuarial science behind Solvency II regulations in the EU.
Okay, thanks. And who calculates those MCR parameters? Is this DAO based, or do you have an internal team?
Yeah, it's a DAO. Well, it's a DAO based. So it's kind of done with a flat factor based on the cover outstanding, and then we run a more complicated model off chain. And if it tells us that we should hold less or more, then we put forward a governance vote to move the factor.
Okay, thanks.
Akiva, I saw you asked a question in the sidebar. Do you want to read that out?
I can grab it directly. Does it cover any smart contract risk or collateral risk? It's not designed. This is tailored cover, not to cover smart contract risk, it's to cover bad debt accruing in the protocol. So it's a bit different from our standard product that we just offer right now. So this is really kind of something new.
Yeah, so I guess you're saying that it would be covering bad debt regardless of the source, whether it's a contract issue or a collateral issue or whatever.
Yeah, sure. I guess smart contract could lead to a debt issue, correct? But yeah, it's basically debt regardless of how it eventuates.
Great, thank you. Any other questions or comments for Hugh before we move on? All right, seems like there's nothing major. I would suggest everyone kind of directs any further questions to the thread in the forum. Have someone can link it in the sidebar. Yeah, I would just like to echo what others are saying. Thank you very much, Hugh, for coming and doing that presentation. I think that was really interesting, and I'm kind of excited to see where it goes. All right, so we're a little late. Vishesh, do you want to do a really quick update, or we can just skip it this week? Up to you.
Yeah. Okay.
Sorry, let me give you a. Yeah. Cool.
All right. So just off the top, in terms of where we're at with the peg. So for the last week, we're basically still sitting at like a steady state around $1.01 for DAI. There's been some movement in ETH price, so there's some fluctuation as well that did coincide with the sudden drop in ETH price. So around the 26, we saw a little bit of a spike, and then again we've seen some increased volume as well, just in the last 24 hours or so, but nothing too significant. It's still holding pretty steady. It's just that, sort of the interceding volumes between the 24th and 26th, for example, were extremely light. So there wasn't much movement then. So you can see here sort of like the trades that have been executed centered around like $1.09, and a majority of that volume being on Uniswap, which is kind of the latest steady equilibrium point, is to have the majority of that volume being on Uniswap. If we look at the DAI USDC pair, so we see here a fair amount on Swerve Curve DYDX. So if we unfilter, so just see that Curve accounts for a majority of the DAI USDC trading volume. And in the last week or so, we've seen that price pretty much centered around $1.01, with a bit of a dip, and with a bit of a spike around the 22nd and 26th, 27th, and then a bit of a dip between around the 24th. That was when the trading volumes were a bit lighter. And then we saw DAI USD basically kind of always has a greater degree of variation in the trades, but this is kind of centered around the same point of $1.01 with sort of a bell-shaped curve in the graph between the 22nd and the 27th. And then DAI USDT basically looking, again, very similar to DAI USDC. Now, so we're sitting at around 937 million total DAI. 337 million of that is from ETH, and the other 600 million is from the other assets. So we have about 3 million from BAT, 400 million from USDC, 100 million from WBTC, 57 million from TUSD, and 23 million from PAX, and then smaller amounts from the other assets, and then 5 million from Link. So if we're to look at the top DAI holders, this is still kind of what we have seen over the last few weeks. So obviously a huge chunk of that is in Compound, about 290 million. And then in terms of the amount that's not locked up in the DSR at the end of the day, though that's a little bit of an irrelevant stat at the moment because it's not really out of circulation in the same way, is the Uniswap V2 pool. So that's top of the list. And then Barnbridge, Curve, another Curve pool, and then Binance. So a majority of the largest positions are in staking protocols or other yield farming, which is kind of as expected. We can sort of inspect the positions for some of these larger vaults. So if we look at USDCA, for example, so you can see here that roughly 360 million of that is below 101% collateralized. So an additional million of that or so is below 100% collateralized, but the largest chunk is between 101 and 100% collateralized. It's pretty much the entirety of the USDC pool is some fraction of 100% collateralized, so 106, 107, 108. And you can see, there's basically like the 3 or 4 largest positions. So the largest 3 are around 40 to 45 million DAI in debt, and they're all 100.6 collateralized. And yeah, I mean, this is, when Primož talks about these positions will be below 100% collateralization in, say December, that's, basically the continuing growth of these debt positions with the stability fee that they currently have, and the rate that fee will accrue. Because basically, if you look at the last updated dates for these vaults, I mean, they by and large haven't been touched in a month. And then, I mean, that's true for a vast majority of stablecoin vaults. Some have been touched in the last 20 days or so, but even that is kind of few and far between. And yeah, so you can sort of see the curve here. I mean, these prices above $1 are kind of irrelevant because you're already there. And it's basically kind of the question of how much of this debt is ahead of this line or below this line. And if we look at some of the other positions, so like BAT, so you see this, the largest position is about 2.5 million DAI in debt, and the next one is 600 million or 600,000, and those are respectively 240 and 198% collateralized, which is pretty decent collateralization. So that's got like a projected liquidation wall around 0.12 for 3.2 million DAI. We look at ETH, which is another large position. So we've got a big liquidation wall at ETH price of 318. So that's about 90 million DAI that we liquidated. You can see that, basically a huge chunk of this debt position is 180% collateralized. And that's about 85 million. And then you look at some of what's interesting though is you look at some of the larger positions. So these like largest 2 vaults, for example, they're about 280 to 300% collateralized, which is very solid. But they only account for, between the 2 of them, like 60 million of the overall DAI portfolio. So it's interesting is in this case, looking at the couple of largest positions is not necessarily representative of the majority of the risk profile for the ETH vaults. So then if we were to, well, and these have been these vaults have been updated sort of quite a bit more regularly. So it seems ETH vault users keep up with their collateral a bit more than stablecoin vault users, which is pretty well expected. If we look at the link vaults, so basically, one large vault with 4.2 million DAI debt, that's 300% collateralized. So that's, again, depending on your expectation of market volatility, that's a comparatively larger buffer. So at a price of 6.5, you would have 4.5 million DAI being liquidated. And yeah, if we look at packs, I'm not necessarily don't necessarily need to go through all of these if people are not interested in seeing all of them. But yeah, basically packs, you've got a somewhat similar but also different case from the USDC vaults, where you have the largest positions, haven't been touched in say a month, but a couple of them have. So it's a little bit interspersed. The largest position being a single vault with 12.6 million DAI debt, and that's currently 100.6 collateralized as well. So that's hasn't been touched in a month. So that's something to watch out for. And I want to talk about USDT and WBTC for a quick sec. So USDT, I mean, again, so there's not a ton of debt here, and then WBTC. Basically, these positions are kept up to date a bit more often. So largest position being 47 million, that was updated like 3 days ago, and you have the largest bucket being collateralized at like 190. So that's that the top two largest vaults account for a massive chunk of the debt there, and so you have a liquidation wall of about 78 million DAI at around price of 10,800. Yeah, so I will push this update to a URL where everyone can access it, play around with it at their leisure, and then yeah, if there's specific questions, I'm happy to double click.
All right, yeah. Thank you, Vishesh. Yeah, the new version seems great. It'll be awesome to be able to see the collateralization curves for all the assets. So seems to be a big win. Anyone have any questions or comments for Vishesh?
So it doesn't look like it.
Yeah, it's been a long meeting. People are getting a little tired, I think. Cool. All right. So I mean, I think we'll finish soon. I'll give like a brief moment for anyone to do any sort of general questions or general QA stuff or final reminders. But it's already fairly late, so I think we'll stop soon. So yeah, any final questions or reminders anyone wants to make? Okay. All right, I think we'll stop there. So yeah, thank you everyone for coming. We will have another one of these next week, and I'm sure I'll see you all then. So yeah, thanks guys. Thank you, Hugh.